Welcome to Subramani. Uh, the mind is something which is very difficult to change and very difficult to convince that what you have done is wrong. Okay, let's put it this way. You decide that gold is a good buy, and you expect because you think it will go up, you go and buy gold, or you think you should buy gold. Immediately when you log in, you see articles on why the dollar is weak, why too much of note printing is happening, why the fiat currency has to fail, and hard metals. So you see all those kind of articles, and you are more and more reinforced that gold is a great bet, right? This is called confirmation bias. You see only what you want to see. Your mind starts editing data in such a beautiful way that you tend to see all those articles which say why gold is a good buy or things like that. What we call this? We call this confirmation bias. What can we do to tackle confirmation bias, right? So first of all, you have to understand that when you want something to happen, you will keep looking for such articles. So let us say you hold a position in the hotel industry and the aviation industry today, and you think you're a very smart contrarian. So you go and buy more and more of airline and hotels, saying, oh, people will just convince themselves that the COVID problem is over. The vaccine is already announced and 2-3 companies have announced, so some effectiveness will be there, so things will be back to normal. You honestly believe this, right? Now go and show your portfolio to somebody in the pharma industry who understands how vaccine works, and he'll tell you, just hold your horses, this is not the way it works, blah blah blah, and he will rip you apart, saying don't assume that the COVID problem is over, right? There is some more way to go, and in the meanwhile maybe there will be other opportunities you will be able to. So you will start thinking in those lines, but you will not do that unless you show your portfolio to somebody else and try to argue about any position that you have taken. So what all can you do to fight the confirmation bias? First of all, what you should do, can do, must do, should do, is take your portfolio to a person who is not invested in those scripts, or runs his own portfolio, and run past every investment of yours like as though you were about to invest. Let's say you got 10,000 shares of Indigo, or you got 10,000 shares of Cholamandalam or something like that. Show him your portfolio, and then, or don't even show him your portfolio, just tell him that, look, I want your view on this company, I'm thinking of going short, right? And suddenly you will find that he will give you enough reasons why that share should be bought. So try giving a contrarian view. I think it worked very well for a friend of mine when he had to sell his property in a suburb of Mumbai. On discussing, I had told him this, so he went to 3 brokers and told them that he wants to buy a property in that particular location. All 3 of them said, oh, market is very tight, there are no good deals, it's very expensive. So from that he estimated that he should get about 2.25 crores for his house. He then went to the 4th broker and said, I want to sell my house, and the price that he got quoted was 1.75. What was happening was the first 3 brokers spoke exactly the language which he wanted to hear, because that time he was a buyer. So they wanted to scare him. They said, no, it's very expensive, deals are not happening, blah blah blah, all those things. When he went to the 4th broker, and he completely changed the argument. Now, what can you do about this? You can sit and argue about your portfolio either by creating a club, an investors club where you are, or join an investors club online. There are a few, and discuss those particular shares. Please understand, the other person could be a part of the management, he could be an analyst who has a position, he could be a fund manager, he could be anybody, you don't know. It's more done with anonymity. The person may be bluffing also, right? So you have to be careful about that. Secondly, find out what is the success rate that you have, right? Define something like, for example, if you define success as you have to get a 20% CAGR over the next 3 years or 15% CAGR over the next 3 years, find how many of your existing shares are giving you that. When the share does not give you, don't try to rationalize. Say, well, this is what works for me. Please understand, even a lion has only a 20% success rate, right? So 5 times it goes out to hunt, it kills only once. This is the truth for the lion. And well, assume that you're a lion in the investment business and find out what is your success rate. Find out when you have failed and don't try to justify. Just calculate why you have failed, or just calculate the fact that you have failed. Then suddenly you may realize that, okay, your success rate is not 20%, it is only 15%, or maybe it is 25%. Then find the kind of sizing that you do. When you are very confident and you think you're 80% probability that you will make money in that script, put very strict stop losses and watch outs for that share, and then take a big stake, because now you are very confident. Take a big stake and find out what are the indicators that you will monitor other than price. Price is the easiest to monitor, doesn't mean that is what you will monitor. Increasing market share, improving pricing power, is the return on equity improving, is the debt going down, are they able to renegotiate better debt at lower rates, right, or more debt at lower rates, are they leveraging more? Look at all those things, look at all those ratios. Forget the price. The price is the easiest and the worst thing to monitor, because you know what is happening in the price, right? This is like trying to understand the game and not just try to understand the scoreboard. If you were to be watching a match live, would you even glance at the scoreboard? Once in a while you may look at the scoreboard, but otherwise you're watching, you know what is happening. Scoreboard is meant for the person who is not watching the match. Somebody who's at a distance, somebody who comes at the end of the day and says, let's see who won, right? For him the scoreboard is important, not for you. So similarly, be careful about what how the bias is hitting you and what all you can do to control the bias. These are two things. One is having a portfolio checked, and second, finding out your success rate, and then making sure that you don't justify every purchase of yours. It is not possible. So and also stop judging yourself on the basis of result. I'll give you one disastrous example in my case. I bought Indigo at slightly less than around 900, slightly less than 1000, 915, 930. I started at 870 and there my purchases ended. And I decided that at least 10% of my portfolio or 15% of my portfolio I will hedge by investing in an energy company. The assumption is, if you have an energy company, sorry, and if energy prices go up, you will make money in the energy company and you will lose money on the airline. Funnily, sadly, happily, whatever, right from April, I found that the energy company has also gone up and Indigo has also gone up, right? So now you can be happy that both have gone up, or you tell yourself it was a wrong hedge, right? It was a completely wrong hedge. Maybe I should have hedged against something else, I do not know, right? So when you judge yourself by the result, you tell yourself, oh, I always knew that energy would go up and I also knew that Indigo would go up. No, it didn't make sense, right? However, similarly, sometimes you can be right and lose money. Sometimes you can be wrong and you make money. When you're wrong and you make money, you realize that you were wrong. That is very important. So then you take remedial action. Maybe now I should get out of the energy fund. Maybe I should get into something else. Maybe I should get out of Indigo. I don't know, but I'm saying don't judge yourself by the result. Judge yourself by the thought process. My thought process was wrong. I should have lost money in one and made money in the other. Good luck that I made money in both. But the process was wrong. So by judging yourself on every action, writing down, maintaining a diary of what you thought and what you did, and then sizing of the transaction. If you were so confident, would you sell your house to put in, will you put 20% of your net worth into that? So if Indigo had gone down from say 900 to 400 for whatever reasons, they didn't do well, the lockdown was more severe, the permissions were not granted, they could not fly abroad, right? So for all those reasons, I would never have accepted it as my failure. I would have said, oh, I took a chance, I wanted to take a chance, I wanted to take risk, right? That's wrong. I didn't want to take risk. None of us ever wants to take risk. We want to get good return and we want to avoid risk, but we are very good at post-event rationalization. We are not rational people, we are rationalizing people, right? So we would have said, we would have found out a fantastic excuse. Our brain would have said, oh, but if this had not happened, or but if that had not happened. So first start thinking probabilistically. See what is the probability of you making money. See what is your hit rate, what is your, define your success. If your success is 15% over 2 years or 3 years, see how many scripts are giving you, how many scripts gave you, and if it's a trading call, keep yourself a time limit and a price limit. So if you buy a share at 20 rupees and for 6 months nothing happens, it was a trading limit, remember. 6 months nothing happens. So what has happened is you've lost opportunity to make money, and maybe your timing was wrong, maybe your script was wrong, whatever. You get out of that script because you've kept an outer limit saying within 6 months if nothing happens I will quit, or if the price goes to 25 I will quit. If you do not keep the time limit, you will hold on to this 20 rupee share for 5 years and then sell it off at 25, which makes no sense, right? So keeping price limit, time limits helps. Having your portfolio reviewed by somebody else helps. Writing down what you're doing, why you're doing helps. When you make mistakes, don't kill yourself with the mistakes that you made. Find out what is your percentage of success. That means your mind is ready that, oh, if I buy 5 shares, one will be a super hit. That's it. So only one super hit you're expecting in 5 shares. You're not expecting everything to be a super hit. And let's face it, there is a concentration in everybody's portfolio, right? So let us assume for a second that Rakesh Jhunjhunwala has a 20,000 crore portfolio. 7,000 crores out of that is Titan, right? Every script that he has bought has not become a Titan. So let us say he's bought 50 scripts, right? Which has not become 50 into 7,000 crores, right? That is not, his net worth is not 3.5 lakh thousand crores. So understand what can happen, understand that success will come in a few scripts and it will not come in every script. Find out what is your ratio, so that what happens is whenever you have a success, you find out that, oh, that is one which has already succeeded, so now let me look for another. Here, while buying, it makes a lot of sense to act like a banker, or act like a lender. A lender expects every rupee to come back. An equity guy does not expect every rupee to come back, so he takes a little more risk. Don't do that. Be careful like Mr. Buffett is, and don't be worried about what money others are making. That is a fund manager's problem, right? Because a fund manager is constantly compared to somebody else and told, oh, you got only 39%, that guy has got 41, right? You are not a fund manager, so that is luck on your side. You are answerable only to your family, you are answerable only to your goals, right? So see what all you can do to do that. It does not matter whether you beat the benchmark, whether you get alpha, as long as you meet your goals, that's fine. So how to beat the confirmation bias is something which we have seen. So you should know that there is something called confirmation bias, and you should know that it can be conquered and you have to take steps to conquer it. Thank you.